Hello, and welcome to Money Mystery No More. Let's talk about embracing risk management with financial planning. Embracing risk sounds funny, doesn't it? Then financial planning sounds smart, or maybe a little serious because of that one word, planning. For real, that means more work, right? It's a good thing though. Financial planning is similar to financial literacy in the sense that it will help you deal with your money more effectively and could very well set you up for financial freedom. And that is also where risk management comes into play. We will explore the relationship and the benefit of applying what you learn. To really benefit and get the most out of this video, listen closely for the strategies and the 4 pillars all coming together as you combine risk management and financial planning to help you enjoy a better financial future by keeping it simple. It's awesome. And remember, hit that subscribe button to keep getting the latest and greatest information. Okay, let's remove the mystery. For the purpose of this video, let's understand what risk management is in the context of your money and your future financial planning. We can pull from the business world and relate it to your financial risk management. A business protects its economic value by mitigating exposure to risk as it relates to their money and financial viability with operations, credit, and the market or industry it is in. So, both you and business share that. You both want risk management strategies. Basic risk management strategies are designed to help manage various financial risk incidents by having a set of actions or plans to mitigate them. These risk incidents are typically things that may occur which cause negative or unwanted stress to your financial situation. The most common risk management strategies normally include risk avoidance, risk reduction, risk transfer, and risk retention. Risk avoidance is a strategy to avoid costly consequences of threats or hazards that can cause damage to the company or, in our conversation, your personal financial situation. The key is to identify as many of those threats as possible, determine the likelihood and risk of each threat, understand the potential damage, then take steps to avoid and deflect those threats. Risk avoidance is a deliberate tactic which can help avoid significant disruptions financially. Risk avoidance for you includes having secure passwords or login credentials on your financial accounts. Risk reduction is a strategy to minimize the actual damage to your personal financial situation by reducing associated risk factors. While avoidance is ideal, it's not always realistic due to natural disasters or cyber attacks, for example. Financially, you should implement concepts like diversification, time compounding, and even dollar cost averaging. Think about your 401k or Roth in which you make contributions continuously. By doing so, you get the benefit of the pricing ebbs and flows. This reduces the risk of overpriced investments on a single day versus if you waited to invest just once per year. Risk transfer. This is a strategy to literally transfer your financial risk of damages to another party. This is an agreement to pay another party to take on some specified potential losses. You may already do this in your financial life through your use of insurance. If you own a home or vehicle, simply consider the risk of significant financial damage to you personally if you had no insurance and something were to happen to your home or vehicle, causing you no use of either one. Your homeowner's or vehicle insurance policy protects you for an agreed upon premium. You've transferred risk from you financially and onto the insurance carrier in the event of a significant loss. Risk retention is a strategy in which one chooses to not transfer risk. You assume all risk to pay for all losses because you may have significant funds and you feel it's less expensive to handle them yourself in the long run. So, you might self-insure. Or in the event you do have insurance, a practice of risk retention is to have a very high deductible to have much lower premiums. With that previous overview of financial risk management strategies, you are likely starting to realize why it's so important as related to your financial planning strategy. Financial planning involves you taking some time to review your long-term and short-term financial goals to understand how your current situation plays into the success of those goals. You literally will start some basic strategies now to start making those goals a reality. Many of the topics covered are also featured videos of this channel, Money Mystery No More. Our videos present a lot of subject matter to help you understand money-related topics such as cash flow, budgeting, retirement, wealth, debt management, credit, investing, and even financial literacy. Most financial planning will lead to a deep dive evaluation of your financial situation right now. It will involve transparency of your income and all, and I mean all, of your debt and expenses in your life. Think of vehicle payments, loans, credit cards, subscriptions, internet, and more. It also involves digging into your goals right now. then 5 to 10 years out, and yes, even your retirement. This means things like your tax strategies, college funds, debt consolidation, risk management, emergency savings, and let's not forget just good old-fashioned basic investing. Are you starting to see the big picture? Are you starting to see why most financial planning encompasses lots of money-related topics, such as cash flow, budgeting, retirement, wealth, debt management, credit, investing, and even financial literacy? Just take small baby steps. A nibble here, a nibble there. Begin absorbing some of that information. If you are willing to embrace both risk management and financial planning, your goals can come true even with the challenges you will likely face along your journey. Now that is exciting. There are many ways to get started in the process of embracing risk management with financial planning. But the first thing you need to remember is that this is unique to you. While there will be some common strategies of goal setting, budgeting, debt management, etc., the plan should be for you and your situation. You take each part and work it up for your goals and situation. That is what makes it unique and why you may even consider getting expert or professional help. There are many people that utilize the services of a CFA, a Certified Financial Advisor, or CFP, a Certified Financial Planner, because they are good at this. They help people work through unique risk management and financial plans. And that will probably include 7 fairly common steps. First, goals. Record your goals onto paper. By writing them down, there is a real connection between your hand and mind. So get out that pen and paper and start writing down your goals. When writing them out, remember to factor the cost. That thing you're shooting for is easier to obtain if you have the cost, so your goals include methods of paying for it. Also set a timeline, a target date, for when you want to achieve each goal. You can adjust later if needed, but if you don't have a date for your goal, it will just linger as a someday. 2. Open the appropriate financial account, be it a checking, savings, or both. Don't just stash cash throughout your house, and remember to include an emergency account into this decision. You'll want funds for the unexpected events in life. 3. Keep track of your income and expenses with a ledger, a spreadsheet, an app, or whatever reliable means work for you. Tracking is a critical part of budgeting. 4. Manage your debt. While having no debt would be fantastic, the reality is most people are dealing with it. The key is to responsibly handle it and minimize it. 5. Diversify. This is a critical component of risk management and financial planning because you basically leverage risk and assets across multiple solutions instead of relying on just one. This is an area where professional advice is beneficial. 6. Think long term. This means planning for your retirement, even if it's 30 years out. Heck, if it is, it's even more important because time is your friend. 7. Death wish. Okay, not quite, but it's got your attention, right? Come on, we're talking about estate planning. Get your legal documents in order for your tangibles, heirlooms, and even medical decisions or needs that may arise. Not a fun topic to discuss, but it is very important to properly safeguard the way you want. You may recall the 4 pillars discussed in the video, Financial Literacy Leads to You Being Rich by Money Mystery No More. Well, there is an argument, a pretty strong argument, that debt, budgeting, saving, and investing are all fantastic risk management topics and important topics of all financial planning. A key component of financial literacy, those 4 pillars are all related and heavily intertwined with your success and path towards financial freedom. Remember, it is possible for you with the simple decision to learn and practice these concepts, including the 4 pillars, and how to leverage them appropriately through your life. You do this by reading a lot of books, pamphlets, and magazines, listening to all kinds of YouTube media specials and podcasts, signing up for financial newsletters and blogs, or talking with some financial pros. And if the risk management side really interests you, maybe obtaining your professional FRM designation as a financial risk manager is up your sleeve. The Global Association of Risk Professionals issues this accreditation, which is globally recognized in financial markets for a premier certification of financial risk professionals. And with that background, you will learn to mitigate many risks, even though they will still likely happen. But hey, you will be better equipped to handle the most common risks, such as loss of a job and the income from it, or getting hit with emergency expenses like health, house, or automobile issues, or the tanking of investments or portfolios due to the economy or unstable markets, or just getting a little too deep into credit card debt, just to name a few items. And on the financial planning side, all of this will be exceptionally beneficial as you become more responsible, more disciplined, and of course, the best part, more financially independent as you learn to take control of your financial future. You will feel much more confident as your financial goals develop. You will actually save money for those big goals or milestones. You will see your short-term and long-term goals start to materialize, and you will likely want to keep on keeping on because it just feels great. All those risks may still happen. In fact, you can count on them because it's life. But with your newfound interest with financial planning, it will indeed be much more manageable and easier to deal with. You will have a plan. By now, you can see the benefits. It makes sense to start now with no delay. Never put off till tomorrow what you can do today. That includes embracing risk management with financial planning now. Feel more confident because you are in a better position to start building your better financial future by keeping it simple. Remember, hit that subscribe button and turn on notifications so you keep getting the latest and greatest information from Money Mystery No More. I'll see you in the next video.